Are you planning to work until you die? Because I'm not.
I definitely am not planning that.
Absolutely not. So in order to prevent this, so we can live our best lives on a beach with our families, we need to talk about US expat tax planning. More specifically, when it comes to one, the annual tax planning that you need to do, and two, long-term planning with your retirement in mind. It's Vanessa from Wander Onwards. Welcome back to my channel. We are talking all things personal finance for US expats abroad. Today, I have my very best friend and a legendary woman in the industry, Natalie. Can you introduce yourself?
Hi, very nice introduction. Thank you. Natalie Goldstein, CEO of Expat Taxes, the leading US tax software for Americans abroad. So if you need to file a tax return back to the US, use myexperttaxes.com. It's just gonna save you a lot of time and effort because I was once there. I was the expat who had to file taxes back and being charged ridiculous amounts of money. And so I created Expat Taxes, and now I'm here to help guide you through your journey as an IRS enrolled agent as well.
That's so gangster. She was upset with the government, so she created a company to fix her own problems. We love a woman on the warpath.
I'm definitely on the warpath for this one. Yeah, it's gotta fix this problem, right? Because I love being abroad. I know a lot of Americans want to be abroad, and they think that the US tax side is gonna be what's stopping them. It's not a deal breaker, I promise you that.
Nope.
You just have to plan for it.
I've been abroad for 10 years. You've been abroad for 9 years. We can say with confidence, this is doable. You can be out here living your best life and tax planning so you don't have to work until the day that you drop dead.
Yes.
So let's get into it. What is expat tax planning? Because it sounds kind of scary.
So expat tax planning is obviously, it depends on your situation, but a blanket definition is you want to get on top of what your tax return would look like for the next year. So there's no surprises, there's no penalties because, you made wrong contributions to retirement accounts or that you withdrew money too early and you broke some tax rule. You don't want to be caught off guard because you owe a lot more than you expected and you don't have enough money to cover that tax liability, or that you want to know what your potential refund will be so that you can plan your next vacation.
Nothing wrong with that.
Yeah, nothing wrong with that.
What did you do with your tax credits it's the child tax credit,
Child
right?
tax credits, investment accounts.
Oh God, you're so responsible. I love it for her, but also we need to go to Majorca soon.
Yes. That sounds lovely.
Yes, and then we'll just go build more companies there.
Always down.
So when you're thinking about how do I prepare for a tax planning session with a professional like Natalie or someone at their company, what do you advise someone to bring?
One is bring your top 3 questions. I don't know how many people will book a tax planning session, and we offer tax planning sessions. So you can actually have a tax planning session with myexperttaxes.com and talk to a tax professional or just work through email, but bring your questions. Top 3 questions. It's really difficult when someone just says, help me plan. What do you want to know? You want, for example, you want to know how to contribute to your US individual retirement account. Okay, that is a question. Then we can figure out, have you been contributing? Are you allowed to contribute? If you're not allowed to contribute, how do we make it so that you are allowed to contribute? Or your question is, I want to, do capital gains harvesting, which basically means I have investments and I want to pull out, some type of capital gains income, but I want to make sure it's under the standard deduction or, some other credits you have so that you're pulling out your capital gains and then you're not having to pay taxes on it. And then that basically means that, you can reinvest it and your cost basis is higher so that later on, additional proceeds won't be taxable. I explained that in a little bit of a long way, but if that's something you're interested in, know that that's something you're interested in. And then, another good question could just be, hey, I'm going to move to a different country, right? That maybe has a lower income tax rate than I'm used to. So I was in Germany, I'm going to move to Mexico now.
That's my plan.
I just used an example. But, how do I handle that? Do I need to be nervous, or can I use my foreign tax credits to carry over for the next 10 years? So bring your best 3 questions. Don't try to solve everything at once because we're not wizards, we're not magicians. Bring your best 3 top questions and then bring your last tax return, right? And then have an overview of what your income will be for the next year, or basically for the current year for your next tax return.
So my question, whenever I do my tax planning sessions, because I am a client, is always, how do I cut down on the amount of tax that I pay every year? Because I have multiple investments, I have income in 3 different countries, and some people like to question whether or not this is a moral question. What is your opinion on that?
Yeah, so coming back to it, the main thing is, how do you reduce the amount of taxes you pay as a higher net worth individual? Not even that, but how do you get your taxable income to be 0 or lower right? How do you not pay US tax? There's a lot of strategy involved, actually. So, of course, there's the traditional expat tax benefits like the foreign earned income exclusion, which will effectively reduce your your US taxable income by up to 120K. So this might be someone if you have a student loan repayment program that's income based and you don't want to pay your student loans back, or you're not able to do it in this year, maybe that's a strategy you want to use the foreign earned income exclusion to then make your adjusted gross income zero. So what that means math-wise is you make 50,000 US dollars abroad and you're eligible to use the foreign earned income exclusion. So you exclude the full $50,000 from US taxes. So your adjusted gross income is now zero, and then your student loan repayment program doesn't require you to pay.
The question was, is it a moral thing to do?
Oh, okay. Now I'm talking about strategy. Now I'm talking about strategy. I mean, I'm not here to talk about morals, really.
Fair.
Because that's your personal situation. I can't answer that for you. I can just tell you from the tax law, what can you do to achieve your goals? And there's nothing wrong. I mean, the thing is, as you advance in your career, as you make more money, you will learn more strategies, right? For another example, if you want to contribute to a Roth IRA, but you are married filing separately because maybe you are married to a non-US citizen, it's actually quite unfair because you can't contribute to a Roth IRA at all if you make over 10,000 US dollars. And that's just not fair because the normal adjusted, gross income threshold is over 150K for everyone else. But just because you're married to a non-US citizen means you can't contribute if you make over 10,000 US dollars. I mean, honestly, it's capped if you make over $1, right? But you can't contribute at all over 10,000 US dollars. However, what you can do is what's called a backdoor Roth IRA conversion, where you contribute to a traditional IRA first, and then you roll that over to a Roth IRA. And on your tax return, you declare your original contribution as a non-deductible contribution. So again, whether it's reducing the amount of tax you pay, whether it's trying to contribute to a Roth IRA, maybe you want to have a lively discussion in the comments about the morals of it, but I'm just here to tell you that there's a lot of strategy involved, and that's why tax planning can be really good for US expats. I mean, I'm 100% sure that every tech billionaire you see out there has their tax planning sessions. Let's put it that way.
100%.
100%.
I want to over-index on the fact that these resources, these tools, these strategies are available for people to take advantage of. And so in my book, I am playing with the guidelines and the rules that are provided for me. And so I agree, it is not a moral question. It is a decision-making, strategy-based question. So try to focus on that when you're thinking long-term about how you want to prepare yourself for retirement and to keep as much money as possible that you earned.
Yeah, and just keep in mind too, you may feel, so for example, if someone has, let's say if they have $30,000 of investment income and then they have $50,000 in wages and they use the foreign earned income exclusion so that their taxable income, is obviously $30,000 minus their standard deduction, you may feel like, oh, I'm cheating because I actually had 50,000 in US, not US wages, but in foreign wages that now is not taxed. But keep in mind, the IRS has thought about this. So actually, when we're computing your tax, if you're using the foreign earned income exclusion, there's going to be a special calculation to factor in how much you excluded with the foreign earned income exclusion so that your tax would be effectively higher than someone that only purely had the $30,000 in investment income. So again, it's not that you're cheating anyone. The IRS is already thinking of your strategy. They've already implemented protocols to make sure that it is fair in some way. And so maybe don't overthink it so much is what I'm saying.
100%, 100%. That's why I pay Natalie to think for me. I consider myself to be a quite bright young lady, and I've happily paid to be a client at My Expat Taxes because I do what I do really, really well, and they do what they do really, really well. So you can focus on what you do really well, and that might not be tax planning, so you have them instead. Yeah. Now, I want to do a few case studies because people are always trying to think about their own individual scenarios, which is totally fair. Let's say you are earning under $50,000 a year, so dollars is the equivalent. What sort of tax planning resources could be available for yourself?
Yeah, so again, this is where probably, God, the scope is so big, I don't know where to focus. So some case studies. I already mentioned the whole student loan repayment program, right? That's one that some expats do ask about, the income driven, so to use the foreign earned income exclusion. What you can also do is, again, if you have investment income, dividends, interest, if you have $10,000 of that, right, and then you have $30,000 of foreign wages, you can use, the foreign earned income exclusion to remove the $30,000, and then you only have left over 10,000 US dollars from your investment income, which is not, you can't use the foreign earned income exclusion on that, but then you can use the standard deduction. And so you get to zero taxable income. So basically you're not paying US tax on your foreign wages or your US investment income that's under the standard deduction.
We love that for you.
That's also a very good strategy, right? Where you can get, that's not $10,000 of investment income that's not taxed. It's pretty good.
That's pretty great.
That's pretty great. And then let me think, another one is, again, like I said, you want to contribute to your IRA. How do you make sure you can contribute? Because if you're using the foreign earned income exclusion and you exclude your $30,000 of wages, you can't contribute to any IRA. You have no taxable compensation. But wait, you can, instead of using the bona fide residence test or the fiscal presence test for the full tax year, you could use the fiscal presence test for only a portion of the tax year, which effectively means you could actually exclude, only 24,000 US dollars and leave 6,000 left over as taxable compensation, which is then obviously under the standard deduction. So you're not paying tax, but then you have enough taxable compensation to contribute to an IRA. So there's so many possibilities. It just depends. What are your top 3 questions, right? And then how do we look into that to kind of optimize it? And then once you answer those 3 questions, you'll probably have another 3 questions about a different topic.
And it's always important to think about what's the end goal, because the answers that you're looking for will differ based off of the country that you end up retiring in. Is that a high tax environment? What's the cost of living? So a personalized tax planning strategy is well worth the investment, which is why I do it as well. Now let's shift gears a little bit. Let's think about a use case where you are a higher income individual. So let's say 150,000 per year, which means that you end up scoping out of the Foreign Earned Income Exclusion Act, at least partially, because you have more than 120,000 in income for 2023. Where would you start with that?
Yeah, so again, I think the most common one I see with this is one, I don't know why, but most expat tax firms and US tax softwares, they will just automatically shift towards the foreign earned income exclusion, when actually for high earners, it can give you a higher tax rate. Like I talked about it, there is an effective higher tax if you're using the foreign earned income exclusion because of the stacking rule. And so if you are earning 150K of wages and then you have investment income on top, if you've used the foreign earned income exclusion, you would actually pay more income tax generally than if you were to use just a pure foreign tax credit approach. And so that is something our software catches it pretty much immediately. When you're filing your taxes with us, even outside of our planning, right? If you're just filing your taxes with us, we will show on the first page of every return, what does your tax return look like under the foreign tax credit model, and what does it look like under the foreign earned income exclusion approach? And then you will see, okay, actually I'm paying $3,000 more tax under foreign earned income exclusion than I would under foreign tax credit. So that's one big one for high earners. Another one is, again, okay, your income is too high to contribute to a Roth IRA, because that will then cap out for pretty much everyone else at about 153,000 US dollars for 2023, I believe. Don't quote me on it. Go look at the contribution limits yourself, right? Or ask us to look at it for you. But essentially, should you do a backdoor Roth IRA conversion instead? Another big question is just, as you get more income, maybe you're looking to do more things. You want to start a company abroad. You want to make investments abroad. How do you do this without getting a nightmare of a surprise on your tax return? So if you start a foreign company somewhere else, so if you're in Germany, you incorporate a GmbH, that means you probably have to file Form 5471, which is, it's a high penalty form. If you don't file, it's a $10,000 penalty. If you are filing it, you could be, some firms charge just $2,000 alone to file this form, right? We charge a lot less. We charge at the moment 299 euros to file this form on top of the premium tier, which is probably the most affordable at the moment, just because of the automation we have. But essentially, you don't want that surprise, because the net profit of your company could also then be taxable as well. Or if you're looking, you're at your local bank in France and they're saying, hey, these are all the great tax efficient investment products here in France. What if they're not tax efficient in the US? And then you end up having PFIFs on Form 8621. And then now you have 30 PFIFs and you have to pay for each one of those form preparations, right? So again, when you're getting into a higher net worth, you're probably doing more things. And it's always good to just clear up what you're doing, especially if it's involving incorporated companies or investing in pooled funds abroad with a tax professional, so you understand what's coming for you. I never want to say don't do it. Most people will say just don't do it. I don't believe in that. I think you should do what you want, but you can do it in a smart way. if you form a company, you can think about how you want to split that shareholding so that maybe your company isn't more than 50% owned by US citizens, and so that the net profit is not taxable by the US. Or maybe when you're investing in foreign mutual funds, you're not asking a robo-advisor to invest in 100 different funds, which results in 100 different PFIF forms, but you're only investing in the top 3. And so it's a very manageable process and more affordable process to do.
That was a lot of really, really good information.
Sorry if it was too much. Maybe you just got a planning session right there for free from me.
Kind of. Whose taxable situation would this look like? I have no idea. Just for context, who would you consider a high net worth individual?
I think really for me is anyone earning over the 400 income exclusion, because then there's just, you know, you have to think about how to use foreign tax credits, right? Or it could even be that maybe your wages is not, but you have, you know, a lot of money, so over, you know, 100K in investments, something like that. I don't really have a definition. The IRS definition, I think, is 125,000 US dollars.
In cash or income?
In salary.
Oh.
But then this is not like a standard definition. This is a definition tied to if your investment in your pension is taxable, and I'm not going to bore you on that, but
It's actually really exciting.
but anyways, I say once you go over the 400 income exclusion.
Is there a certain age that someone should be thinking about this more seriously? Because when we were 25, I think we can all agree we were a hot mess.
Would you actually? I think I started. Was I 25 when I started my expat taxes? I think I was.
Oh my God, who are you? Okay, I was a hot mess.
Yeah, I think
she was
so.
changing lives. Oh, you think I was a hot mess?
No, I think I was 25 when I started. I can't remember anymore. Now I'm getting old.
Thank God. At what age should someone start thinking seriously about tax planning?
I think you can think about it at any age, right? But I mean, I guess I'm a little bit special. You should get more serious about it when you start a family. I think that's kind of the main thing. Or when you have a big event you're trying to do. You want to get a house, you want to, you know, have a family, you want to start a company. These are generally the moments where you want to have a little bit extra cash, and you want to have a savings, and you want to have a rainy day fund. So that's when you should really think more about planning. But obviously you can do it at any time. It's always good to have a plan, right? I always had a plan, but yeah, I guess I'm a little bit odd.
She's very egg-tight, but we love that for her. Okay, I think that was a lot of incredible information. So we will put down links about how you can find out about tax planning with My Expat Taxes later on. If you're liking this video, don't forget to hit that subscribe button and to hit that like, because it really helps out my channel.
Thanks for watching. If you liked that video, please give it a thumbs up and subscribe to my channel.